So investing in Washington Mutual shares could be really risky right now, but should you pull your money out of the bank? So I grabbed Farnoosh Torabi, author of You're So Money, to tell us, when do you think it's time to get out of Washington Mutual?
Well, it's not really a when as much as how much money do you have at Washington Mutual, or any bank for that matter. Note that the FDIC, which is the Federal Deposit Insurance Corporation, thanks to the New Deal back in 1933, was established to insure your deposits at a savings and loan bank. So if you have more than $100,000 in your account, I would pull some of that out, because the FDIC only insures up to $100,000 per account. Maybe move that over to another account at another bank. But also know that at the same bank, you could have a retirement account that's insured separately up to $250,000. That's like an IRA account. Also, though, if you have a joint account, so you get even more. If you have a joint account with a husband or a wife or your partner, that's also insured up to $100,000. So in theory, you could have about $450,000 in one bank, whether it's Washington Mutual or Citibank or Bank of America. It's insured with provisions, and so it's not really like, oh no, the stock is falling, I should move my money out of my savings account.
But if Washington Mutual gets bought or it goes bankrupt or goes under, what happens to my money? How do I know that I get it?
Your money's still there. Essentially, what might change that you notice as a consumer is the name of the bank changes, so maybe you have to get new checks printed.
Okay.
But basically, the phone number is the same. You just have to become more accustomed to dealing with a different customer service, maybe maybe a new CEO, maybe some closed locations.
Now, if I do want to get out of Washington Mutual, what's a way to look for safer banks, quote unquote?
Okay.
Banks that don't have any risk in the market.
Right. That's a really good question. If I knew what banks didn't have risk in this market, I'd be talking to the Fed right now and not necessarily with you. However, there are things to look out for. You want to make sure that your bank has cash reserves, that it's not a bank that maybe got involved in these risky mortgages. A lot of the, for example, credit unions were averse to all of this. So they're banks that are still giving out loans. You know, if you go to a bank and they're not going to give you a loan, and you've got really good credit, you've got a really good credit score, and you've got proof of income and cash in the bank, all these great ingredients that qualify you as a good borrower, and they're still not going to give you money or a line of credit, know that they probably have their hands tied behind their backs. You may not want to, it's not about whether or not they're risky or not. It's basically whether or not the FDIC is going to be there to protect you. And so as far as we know, that organization will be intact, will be in place to help us in case a bank needs a bailout.
Great, thanks so much, Farnoosh. And for more, if you want to break down banks, you can go to bankingmyway.com and check out Farnoosh Torabi's article on mainstreet.com.